Hey guys, TommyBryson here and welcome back to the channel. And for this video, I'm going to teach you the basics of accounting with a very simple story. And by the way, I did 4 years, not in jail, but in school, in college. And I graduated with a degree in accounting. So for those that don't know, I have a bachelor's degree in accounting. And in all honesty, the way I was taught in college was more like, hey, you do this, and you get that. And it sounds good and I'm able to do that. That's why I got A's and I graduated with honors, but it doesn't help you understand fundamentally what everything is and how everything connects. So that's why that's my goal for this video right here. Now, I am gonna recommend someone else in this video, and that person is called Layla. Now, Layla is an accountant, an economist, and also a YouTuber, and she makes videos specifically on this topic. So although this video right here is on the basics, eventually, once you comprehend this, by the end of this video, you're gonna wanna get into more intricate ideas in accounting and go even deeper. And by the way, Layla has courses, free content, everything that you basically need. So I'm gonna link her channel down below because why wouldn't I send you over to a place that's probably gonna be the best teacher you ever had? I don't mind putting someone's name out there, especially when they're that good as Layla. Again, the link is down below. But as always, guys, do me a favor though, smash the like button on this video. And also, if you're new here, subscribe to the channel and hit the bell so you're notified. Now, let's get started with this fictional story. Now, Billy is the character here. Billy is 10 years old and has to be the smartest kid I ever met in my entire life, which by the way, is very surprising because Billy's parents are as smart as a sack of potatoes. However, they're very loving, kind, they're frugal people, and you know, they're good people overall. So the smartness doesn't really matter that much. But one day, Billy decides all of a sudden he wants to be the next Fortune 500 company owner. He wants to be an entrepreneur after watching an entire season of Shark Tank. All right, who hasn't been there? We've all been there, okay? But Billy goes to his dad and tells him, hey dad, I want to start a business. The dad says, okay, what's the business? Remember, the dad is as smart as a sack of potatoes, okay? And by the way, you'll notice that the dad is as smart as all of us basically are because most of us don't know anything about accounting, okay, or business. So he tells the dad, well, dad, I want to start a lemonade stand and I just need 3 things from you, dad. And the dad says, well, Billy, what are those 3 things, okay? And he says, well, first of all, I'm going to need an LLC. And the dad says, well, why would you want to get an LLC and what is that? Billy says, well, an LLC is a limited liability company. And the reason I want to get it, dad, is because this way, if Mindy from across the street comes to my business and slips or says that I poisoned her or wants to sue me and she wins the case, well, they can only take what the company actually has because the business is its own entity and it's not really associated with my personal finances. So the liability is limited to the company, so they can't come after what I actually own. For example, my personal house, which I don't have right now, but that's the idea. That says, okay, I get it, I understand it, that is smart, is protection, okay? That has a very good way to break things down into one word. Protection. And then he says, well, what's the second thing you need? He says, dad, I'm gonna need an accountant. And he says, for what? Like just to file taxes? He says, no, dad, this is a business. So overall, I'm gonna have to record all of these transactions, prepare financial statements and everything else. So dad says, why is that important? Because that accounting is the language of business and these financial statements are gonna help me understand what the health of the company basically is. So dad says, well, okay, you wanna know more. All right, dad, yeah, that's it. Now, what's the third thing you need? Well, dad, you know, I'm 10 years old, Billy says, so I need money. I don't have the money, okay? And the dad says, remember, these people, they're smart as a bag of rocks, basically, but they're very frugal, loving people, and they believe in hard work pays everything. Dad says, I can help you with 2 things, okay, Billy? He says, what? I can help you with a recommendation for an accountant and tell you where to open up the LLC, but as far as money, I'm gonna go ahead and recommend you for a job. And right here is a paper route. Billy is a little mad about the whole thing, but he starts working the paper route, and 6 months later, he manages to save approximately $1,000 exactly. Why would I say approximately if it's $1,000 exactly? Now, here's what happens next. He has the money he needs, so he goes to an accountant with his dad and says, hey, can you go ahead and start the paperwork for the LLC formation and everything I basically need? The accountant says, yes, I can do that, but it's going to cost you $200. And then Billy says, well, do you also have an in-house bookkeeper? He says, yes, we actually have Layla here. And he says, well, how much is it going to cost me? He says, well, it's based on your transaction. He says, well, it's not going to be that complicated. Can you charge me $100 a month? I'm just getting started. And the dad is impressed, okay? Because Billy is very good at negotiating. But once they leave, he asks Billy, why didn't you just do your own accounting? You're smart enough. Why don't you just do your own journal entries? You're smart enough. And then he says, well, Dad, because that business side of things, that activity can only make me like $30 is what it's saving me, but I can make so much more money by doing something else. This is called, Dad, opportunity cost. So Dad says, wow. So basically, you make more money doing something else than you would doing your taxes and stuff, okay? Then Billy says, yeah, Dad, that's basically it, okay? By the way, this dad is not that dumb, is he, huh? So now he's fully in business. He opens up a separate business account to have all the transactions separate to make sure that everything is just going to flow on one side and it doesn't get mixed up with his personal money. He opens it up with a balance of $700. Now, everything is fine. He hires his mom to do some marketing and also as a 1099 contractor to pay her some money to do most of the work at the stand because Billy isn't really going to do a lot of stuff there, okay? And he's only going to work like the summertime because obviously he has school. And in the summer, he has 60 days to actually work. And when business starts, let's just say things start booming. He buys the stand, the flyers, the little sign, and he calls his business Just Lemonade. Which, by the way, can be a real business because we don't know what they put in anything these days. Everything has a chemical. Now, this is just lemonade. That's an awesome name, okay? Now, here's what happens, okay? 60 days of business. He sells to 100 customers every single day for those 60 days. And he sells lemonade for $3 a cup. Yeah, it's like a Starbucks lemonade, okay? Billy knows about pricing power here. And his lemonade is the best. So people are coming, and they're coming in flows. And they're taking Instagram pictures, they're lining up, and everything. Now, after the summer's over, guess where Billy goes? He goes over to the accountant's office. He brings his dad, and he wants to know the financial health of his company. Now, the accountant tells him, hey, Billy, we've managed to basically track all your transactions using journal entries. We have a bookkeeper for that stuff. And what we did was basically, we have journal entries. So whenever you have a transaction, we use double entry accounting to debit somewhere and credit somewhere else to make sure that everything is balancing out. So we have a general ledger with the list of all of your accounts. And we also have a T balance sheet that shows you the ending balance for each account. Billy says, wow, you guys are very detailed, okay? That's awesome. Now, Billy says, well, I want to know the financial health of my company. I want to know what's actually going on. So can you show me the financial statements, okay? And they hand him 3 financial statements. The first one is called the income statement. Now, this is also known as the profit or loss statement, okay? Or the profit or loss sheet, okay? Now, here's the thing. The dad asks, hey, what is that? What is an income statement? And Billy responds by saying, Dad, the income statement is going to show us how much revenue we actually made, how much money it costs us to make that revenue, how much money it costs us to operate the business, and also all of our expenses to know exactly how much money we actually netted, like overall. Like once expenses are over, how much money did we actually make? The dad says, well, basically how much money you made after all expenses. What you're saying, Billy, okay? He says, yes, Dad. That's what it says, okay? Now, I prepared a little sheet here for us, okay? Now, this right here is the income statements that Billy actually got. Now, remember, Billy sold 100, okay, to 100 customers, $3 a cup for 60 days. So he made around $18,000 in revenue in 2 months. Not bad for a 10-year-old, if you ask me. So obviously, the income statement here for Just Lemonade is going to show us the revenue, the expenses, total expenses, and also what the net income actually is, and also the net income after the taxes right here, okay? Now, what it shows here, okay? He made $18,000. Now, he could have made more money from service revenue. Maybe he gave another company some services and so on. Maybe he sold something else. Maybe he has some interest actually coming in. All the revenue would go right here on this revenue line. But he only made $18,000. That's all he did. Now, advertising. Remember, he hired his mom for advertising. His mom just printed out some pamphlets, gave it to the ladies at church, and that's basically what they basically did there. But they spent around $180 on that. Let me zoom in a little bit more so you guys can actually see it a little bit better. But $18,000 revenue, and then advertising, 180 bucks. Then cost of goods sold was $600. Tommy, what's cost of goods sold? Well, it's in the name. It's basically what it took to actually make the product, to actually make that revenue. So basically, that lemonade, what did it cost? What were the cost of goods sold here? You have lemons to actually squeeze, and the ice and the little straws. All that stuff goes into cost of goods sold. However, what people don't know about Just Lemonade or Billy's Lemonade is that basically he has a white label business. He's very smart. He doesn't want to squeeze lemonade all day. What he does is he outsources lemonade from a company in Mexico, and it's just lemonade, fully organic from a farm. They bring it over to him. He puts his little label on it. That's called white label, by the way, and calls it Just Lemonade and pours that in. So for every cup of lemonade he actually sells, it only costs him around $1. And how much did he sell? He sold 600 cups, so thus $600 in cost of goods sold. On top of that, he bought some furniture and equipment. The furniture was a chair or 2 chairs for him and his mom. He also bought the stand, the sign, and everything. So that was around $500. And as you can see here, you would have here, for example, rent and wages, payroll expense, office supply, everything here, but it's a very simple business. So you don't have to include any of this stuff for his business. Now, he has salary and wages. Now, Billy is smart. He didn't hire his mom as an actual employee, okay, like a W-2 employee. He hired her as a contractor. So she picks her own hours. She can come to work whenever she wants to. And he paid her $2,000. $1,000 for 1 month, $1,000 for the next month. That's basically it. So the total expenses were $3,280. So after that, he basically net income before taxes was $14,720. Now, by the way, in some income statements, you usually see something called EBIT, which is earnings before interest and taxes. That's basically BS earnings because you do want to deduct interest and taxes. Sometimes you see, for example, EBITDA, which is earnings before interest, taxes, amortization, and also depreciation. That basically means like it's kind of like just like earnings without everything that actually is going to be deducted from it. So you don't want to look at that, okay? But overall, you're going to see here, he paid around 20% in taxes. So his net was actually $11,776. Now, he says, wow, this is awesome. The dad says, why is it awesome? You literally made $18,000. You only got $11,000. That's so dumb. He says, well, Dad, remember, I have expenses. I have my revenue. But the business is profitable. And it is very profitable. Because it basically means from $18,000 in revenue, I made $11,000. And by the way, Dad, guess what, Dad? I only spent, again, $3,280 on my expenses. I made $18,000 in revenue, Dad. So that means that, guess what? I only spent around 18% of my money on expenses. So the other 80%, 82% goes straight for my bottom line. Well, now after taxes and everything and so on. So he says, wow, that is actually pretty good. You're making profits. Now, the second financial statement he actually gets is a balance sheet. Now, before Billy looks at it, his dad asks, say, what's a balance sheet? And why is this stuff so important? Well, Billy says, hey, a balance sheet, Dad, is going to show me the assets. What are assets? Well, the assets, Dad, are the things that the business actually owns. It also shows me the liabilities. What are those? Liabilities are basically the things the company owes money on. So if I borrowed any money, if I have any loans, if I have any bills I haven't paid. And the assets can be, for example, the equipment I actually own that's paid for, the cash I actually have, the inventory, all those things right there are assets. Now, it also shows me equity. What's equity? Well, equity is how much money the owner actually has in the business, like overall, like what do you actually have? Like what's your equity? And equity always equals assets minus liability. Now, why does this matter? Well, it shows us, Dad, that if I were to close operations today and I basically sold my assets, kept the cash, paid the debts, the liabilities, what I would keep over would be the equity, the money for the owners. That's what that is, Dad, okay? He says, wow, okay, so that makes sense. So if you close on the business, that's the equity that's left over. Basically, the balance that's left over is the equity. He says, yeah, Dad. The balance after that's the liability, that's the equity. He says, wow, that makes sense. So here is this sheet, and we're gonna go ahead and take a look at it, okay? Now over here, we have the balance sheet. Now the balance sheet has assets and it also has liabilities. Now let me zoom in here because none of us have glasses except for me, okay? But overall, it has assets and it also has liabilities. Now on the asset column over here, what are we gonna put in? Well, we have cash of $10,000. We have inventory of $600. And we also have property and equipment of $500. Now, as you can see, there are other things here like investments. You also have, for example, equity and other investments. You also have, for example, if you're, why is charity in here? That's actually pretty strange. So I don't know why they put charity here, but you get it, right? The assets are basically all the things the business basically owns, including the cash, including like the furniture, the inventory, everything, and also including accounts receivable. This right here is massive. Accounts receivable is, say for example, Billy had a program where if you don't have any money, you could go into the business and buy some lemonade and just basically pay later. He would put the money that you actually owe in here. So if he had, for example, one customer that bought a lemonade and hasn't paid him, he puts $3 in there because, hey, accounts receivable, they owe me money, okay? And that goes in here. Now, here we go, guys, okay? Because we also have the liability section. And liability section shows everything he actually owes. Now, the good thing for Billy is he doesn't owe anybody any money because of accounts payable. He doesn't have any accrued wages, like wages he actually owes money on, compensation. He doesn't have any income tax he actually owes money on. He doesn't have any unearned revenue. He doesn't have any of this stuff, okay? He's basically a business running with no debt whatsoever, which is awesome. But overall, when you go back here to the summary, it shows us, hey, I have current assets of $10,600, fixed assets are $500, which makes the total assets of $11,100. I have zero liability, and the balance is $11,100, which is assets minus liability equals the balance, or for example, equity. And equity is always going to equal to assets minus liability, okay? So if you ever want to kind of like know what the difference is, you can just go straight into equity and know exactly what assets minus liability actually are. And it always shows you right here. Now, he's actually pretty happy with this because it shows that, hey, we have a very strong balance sheet. We have good assets, a lot of assets actually, and we also have no debt. That is very strong. However, let's say if he had like, I don't know, $20,000 in debt, and that would be a liability, obviously. And then what would happen is this, okay? So if we go back into the sheet here, here's what would happen. If we go back to the sheet here, and he has, for example, $20,000 in debt, let's call it, for example, investment capital, long-term liability, mortgage payable. No, let's call it some debt. Okay, let's call it some debt. So he has some debt that he actually borrowed money for, and it's basically a $20,000 loan that he actually got. Okay, so what it shows us here? Here's a summary. Summary is owner's equity is $8,900. So if they chose to close on the business right now, they would have a balance due of $8,900 because they owe more money than they actually have in assets. That's actually not good. So have a strong balance sheet. So Billy is very happy with this. The dad understands it. Now, the third financial statement he actually receives is called a cash flow statement. Now, what's a cash flow statement? Okay, the dad asks. Well, Dad, if you want to know how good a business is, like my business, wouldn't you want to know what I do with the cash and how I use it? Well, obviously, Billy, because anyone can earn a lot of money, but what if you're using the money for something stupid and you lose all the money, right? So, of course I want to do that. Well, Dad, That's what the cash flow statement shows. It shows basically what's happening with the cash. What is the cash being used for? And what has been basically, what's the return on everything you've been using the cash for? So you have some companies that a lot of times they kind of earn a lot of money revenue, they have a lot of cash, and they use that cash to buy, for example, certain investments. Investments are terrible, and they reflect in the cash flow statement to say, hey, from the cash you used to buy this investment, you've actually generated negative $500,000. Okay, so you've done a terrible job. So all that stuff there reflects and shows you, which is very important. So here's what we see when we go over to the cash flow statement. Well, we see here that he had customers, right? He had $18,000 in revenue. Again, zoom in here because no one has glasses. $18,000 in revenue. And he had inventory purchases of $600, right? Because he had to buy the inventory to actually be able to sell what he needs to sell, his lemonade. He had, administrative expenses of maybe like $180. He had wages expenses of $2,000. Income taxes, he actually paid it off for $2,944. And he also had, for example, cash paid for purchase of property and equipment. Yeah, so the stand and everything else, $500. And then it shows that basically he has a net increase in cash of $11,776. But don't forget, he started off the account with $700. So $700, the starting balance, plus the net increase in cash flow after you deduct everything you spend the money on. He has a cash at the end of the year of $12,476. So I noticed a mistake here, and it's that basically when it came to the cash or the assets, I never added his $700 balance that he actually had initially. So what is going on here? Equal, there you go, and boom, $10,500. And now if you go to the summary, it shows here $11,800. If you go to the cash flow statement, boom, everything is solid. The general idea is, guys, in simple terms, is that the income statement is going to show you, is this company making money or losing money? The balance sheet is going to show you, well, what does this company own and what does it owe money on? And if it has a lot of debt, right? And by the way, a company only has debt usually to produce more revenue. And in business, you call that, for example, like cost of capital. So what does it have between its debts and the equity it actually has from other people? And if it has, for example, like a lot of debt and is not able to actually have any real reproduction in revenue, then it's not really good. And when a company has a ton of debt and very few assets, it's kind of like not such a strong balance sheet. And the cash flow statement kind of shows you, hey, here's what this company uses the cash for. And is it actually profitable what they're actually using? Are they actually smart with the cash? That's what it's going to show you. But overall, these are the basics of financial statements. Income statements, balance sheets, and also cash flow statements. Now, it doesn't stop there, because I know for sure a lot more other people are going to have a lot more question, okay? Kind of just like Billy's dad. Because when I was in college, I was Billy's dad. Sometimes I'm Billy's dad. All the time. Now, before I end this story, guys, I do want to answer some more questions because I know some people are going to have these questions, okay? And I'll tell you the end of Billy's story in just a second here. But overall, when it comes to accounting, it's just you basically recording, analyzing, and reporting financial information. That's all you're really doing here. And the idea is you are a walk-in, live-in, record transactions, and your goal is to put all those boring numbers into something that's actually more comprehensive and a lot better off, okay? So when you think about journal entries, think about, this is what we use to record things, okay? When you think about double entry accounting, think about, for example, I use double entry to basically say, whenever I do one thing, one account, I have to do it in another account or two accounts. That's the idea. When you think about credits and debits, think about credit as the source of whatever's happening and debit as the destination of whatever's happening, okay? And whenever you think about accounts and which account do you debit, which account do you credit, that's super confusing. I was confused in the beginning, especially like in college. If you ever get confused when it comes to, well, what do you credit, what do you debit? If you're trying to record a journal entry where Billy buys, for example, the stand and the equipment for $500 and he uses cash, well, how do you record that? And how do I know if I debit cash, if I credit cash, if I credit equipment, and if I debit this? Well, the answer is, there's a simple way to do this, and it's basically ADEXLR, which the synonym or the actual word for it is basically accountants don't expect lower earnings rates. Now, what this means is basically, in terms, is that whenever it comes to accounts, you have two groups of accounts, and the first group of accounts, whenever you debit, it goes up. Whenever you credit, it goes down. And the second group, whenever you credit, it goes up, and whenever you debit, it goes down. Basically, one group does the opposite of the other group. But the ADEX are gonna be the assets, the dividends, and also the expenses. Now, these three types of accounts right here, whenever you debit, they go up. Whenever you credit, they go down. So if you want to make cash go down, what do? You credit. If you want to make cash go up, what do? You basically debit. Okay, that's the idea, because cash is an asset. And basically assets, dividends, and also, for example, expenses, whenever you debit them, they go up. Whenever you credit them, they go down. So remember that. That's ADEX. Now, the lower part of it is basically for liabilities, right? So you have liabilities, equity, and also revenue. Now, whenever you credit revenue, it goes up. And whenever you debit revenue, it goes down. It's kind of like the opposite, you see? It's the exact same opposite. So for example, if I wanted to record a journal entry, well, I have cash. The starting balance for the cash for Billy's company was $700. He's gonna buy equipment for $500. So if I wanna make cash go down, remember ADEX, am I gonna debit cash or I'm gonna credit cash? The answer is I'm gonna credit cash for $500. Now remember, it's double entry accounting. So for whatever account I do something to, I also have to have a credit somewhere else. For whatever I debit, it credit. For whatever credit, it debits somewhere else, because everything has to match up, okay? So when I go ahead and I credit cash for $500, I'm gonna go ahead and debit equipment, right? And that's gonna make equipment go up, right? That's the idea. And that's what journal entries in a way are, double entry accounting basically is. And this trick of ADEX, it really does help out a lot, because it makes it a lot easier when you think about, hey, what do you debit? What do you credit? What's going to go up? What's going to go down? So if you don't remember this, it's just ADEX LER. And if you ever forget the ADEX LER thing, just remember accountants don't expect lower earning rates, okay? That's the little synonym for it. I'm definitely gonna forget those words. I'd rather just remember ADEX LER. I think I remember that a lot more. Now, let me end this story the right way. Eventually, 3 years later in total, Billy went ahead, converted his LLC into a C Corp. He actually issued out shares, collected equity or money from other people, and went ahead and opened up 500 stands, and basically business started booming like crazy, a lot more revenue. And by the age of 14, 13, he became a millionaire. Now, by the age of 18, Coca-Cola could not ignore him. He opened up more locations in better places. The profit margins stayed the same, and he noticed that if I can't make money during the summer, I'm just gonna sell lemonade in the supermarkets, and my brand is strong enough, so it's gonna handle it. And Coca-Cola bought him out, and he made around, I think it was, let me see how down here, he made around $5.9 billion. Now, is this his true story or is it not? Who knows? Ask Billy's dad. But guys, that's basically it for this video, and I hope this video actually helped you understand accounting or understand some basics in some way. And again, I want you guys to go visit Layla's channel, because she has a lot more videos than I do in accounting, because my channel is more about making money and the actual way to actually do everything, and how to invest, what to invest money into, how to pay off debt, like all that good stuff. But every now and then I want to dive into my accounting roots, and right now I'm evaluating a lot of companies, so I'm doing more and more accounting every single day. So I just thought, let me make a video to break things down a little bit more. And the best way to learn is to teach, in my opinion. But thanks for watching again. Like, subscribe, hit the bell so you're notified. Comment down below any questions. Up here is another video. Click the video. Up here is my channel, and also Layla's channel. Subscribe over there too. Thanks for watching, and as always, long-term team out.